Well, welcome to Grant's Interest Rate Radio. I welcome Grant's subscribers and Grant subscribers to be. Please know that we are glad to have you, and indeed, we would like to hear from you directly. Please write us with questions you might want us to address on these broadcasts to editor@grantspub.com. That's editor@grantspub.com. And let me see, as this do-it-yourself commercial proceeds, I would urge you also, if you are of a mind, to partake of almost daily grants, which is our daily blast on the markets. We like to think that we are adding some value to what has happened and speculating a little bit constructively on what may happen. So that's a few hundred words of grants every day, and just log into the website and, I don't know, enjoy. What else, Evan? We have a conference coming up in October. You can sign up for that too. In fact, today you can make it a special day by subscribing to grants and by reserving a seat at the conference. Yeah, it'd be a pretty good day. With me, as you have heard me indicate, is the great Evan Lorenz, the deputy editor of grants and analyst, I was going to say par excellence, I'm going to say non-pareil. And non-pareil being a French term, will introduce one of the topics of today's podcast, Evan, which is the goings-on in France. Now, I can't pretend to be an authority on that great country sitting here in Lower Manhattan, but I do have some data which I would like to share with you. This strikes me as just absolutely crazy. So as you know, ladies and gentlemen, there is upcoming imminently in France an election that may just wind up pitting, possibly, if all goes well, or as the case may be, according to preference, badly, in the first round elections, which I think are coming up on Sunday. If all goes badly, let us say, in that election, we may see a runoff between Marine Le Pen on the one hand and Jean-Luc Mélenchon on the other, he being on the left hand and Marine being on the right hand. Now, Marine stands for approximately the exit of France from the euro and the ultimate restoration of the rather unmourned French franc. Jean-Luc Mélenchon stands for basically confiscation of income. However, that would be some mitigation of that threat because you work less in exchange for 90% marginal tax rate. So that's that program. So, Evan, this is a question to an answer I know you know because you have furnished me with the answer. But will you care to guess how French securities are priced in expectation of the possibility of this existential threat to French financial stability and indeed to the euro?
Given the breathless coverage from analysts talking about how the French bonds have been selling off, I'd guess the two-year bond is roughly negative.
Correct. As we speak, the French two-year bond is quoted at minus 33.6 basis points. A disastrous sell-off from levels probably more closely aligned with the yield, two-year yield in Austria, that's minus 65 basis points, or indeed Switzerland, which is 100 basis points negative. France is merely 33.6 basis points negative. So that's the two-year note. The 5-year is barely positive, and the 10-year French security is 93.5 basis points. So this is how the market, doctored as it is by the European Central Bank, prepares for this existential political threat. This is just, to me, is just nuts.
Yeah, today the Japanese 10-year bond shot into below 0% for the first time since November on fears of, the election in France.
So, Evan, this morning I attended a session at the Council on Foreign Relations here in Manhattan, and the speaker was an eminent French technocrat named Benoit Cœuré. He's a member of the executive board of the European Central Bank. And Mr. Cœuré seemed very sure of himself. He insisted that, he didn't insist, he asserted that tail risk is off the table in Europe. European Central Bank has disposed of the risk of deflation. It has bought bonds judiciously in the interest of French growth. I asked him, quoting the wise Frenchman of the 19th century, Friedrich Bastiat. I said, Friedrich Bastiat said, apropos of government policy, that there is that which is seen and that which is unseen. And that which is seen in Europe now is at least some level of positive economic growth and, some level of financial prosperity, all very good. But I said, Mr. Courbet, said, what might constitute the unseen adverse consequences of these policies, which feature, as readers of Grant's know, rates of growth in the French balance sheet, in the European Central Bank balance sheet, bordering on 40% per annum. What might be the adverse consequences? I asked Mr. Courbet, and he said, and he enumerated some rather bland possibilities of disappointment. But he did not mention the systematic manipulation of yields and the suppression of the evidence of risk through the suppression of yields. And I thought it was a rather extraordinary display of sang-froid, to use another French expression. Now, Evan, I know that you have been studying the complacency of central bankers on the North American continent. Will you care to report what you have found?
Yeah, the Fed in its March minutes basically came out and said, we're going to continue raising rates, and in the second half of 2017, we're going to actually begin shrinking our balance sheet. We'll run off our securities portfolio. And in a survey the Wall Street Journal did last week of economists, most economists seemed to agree with that sentiment. This week, Stanley Fischer, who's the vice chairman of the Fed, gave a speech that was a bit remarkable for its blasé attitude towards risk and towards the unintended consequences of central bank action. He said, note the lack of market reaction when we released our minutes. Nobody was shocked that we're going to sell off our securities portfolio. This means we're doing everything right, and we'll be able to, reduce our $4.4 trillion.
Well, this strikes me as remarkable on several counts, one of which is that the Fed, I say, evidences a deep institutional suspicion of markets and of price discovery. And I say this on the evidence of the post-2007 extraordinary, now rather conventional, Fed actions to raise up asset prices and horse around interest rates. So the Fed, on the evidence of the past almost 10 years, has shown a certain contempt, or at least it's a loaded word, disdain, or judges itself wiser, I would say, in setting prices that markets might be in discovering them. And let us pause here, Evan, and note that it will soon be 10 years that these extraordinary policies were put in place with the explicit promise, certainly with the implicit one, that they would be short-lived and emergency measures only. They remind me a little bit of the temporary World War II housing called Quonset huts, that still standing 60 or 65 years later on certain state college campuses. Evan, as you were saying, Stanley Fischer is at peace.
He's at peace, and he even asked himself, can the Fed be too transparent, too predictable? But on the Fed and the markets, Dudley, the president of the New York Fed, has come out multiple times and said the markets are just one tool in order to affect Fed policy. We've flooded the system with so many excess reserves through three rounds of quantitative easing that we can't really move short-term rates that easy. But we can influence market prices.
He is making our point that that money itself has become an instrument of national policy, of course. The value of money, and a mere tool in the so-called tool chest, which phrase I find cringe-making, and that the stock market and the bond market are likewise instruments of monetary policy, rather than, say, places where people try to discover value. It is, Evan, I'm doing very well to keep my temper, but you please do proceed.
The question is, what can go wrong? Right now, global bankers and their cohorts see a world that's doing pretty well. The IMF came out this week and raised its estimates for 2017 global growth to 3.5%. Last year, the agency believes the world grew at 3.1%. This week, China announced that fourth quarter GDP grew at 6.9%, which is a 2-year high.
Would those be audited data, Evan?
They would not be audited. Oh. And it's also remarkable that China can report first quarter data so fresh off the books. The U.S. won't even try making its first estimate for another few weeks now. But As we noted in our last issue, it does seem China did pretty well in the first quarter, and not just from official statistics, but there's actually an index that tries to measure Chinese factory activity from satellite photos. And from looking, several thousand feet above the Earth, it looks like China actually was pretty busy in
Big data, Evan.
Big data. On the way up of that giant credit bubble, we saw the prices of commodities and basically anything Chinese people can speculate surge. The easiest to look at is iron ore, which went from a bear market in the first part of 2016 to an absolute bull market by the end of the year. However, in the last month and a half or so, iron ore sold off pretty hard. That Chinese credit bubbles run into a couple of issues that we detailed in the last issue, and Chinese regulators are getting a bit concerned that speculation has gotten too ahead of itself and is now risking the economy itself. So there's been a crackdown on lending, there's been a crackdown on banks, and we've seen commodities sell off. The reason why this is important is approximately 3/4 of the growth the IMF is expecting this year comes from developing economies as opposed to developed economies. Most developing economies are tied into the commodity cycle. So as China was stimulating its growth and building, redundant empty apartment buildings or office buildings, it led to a massive draw-in of iron ore, aggregates to build concrete from around the world, and this boosted global growth in the developing economies. If this is on the down cycle, it could mean that the rosy expectations that the IMF, the Fed, and just about every other central bank out there has are wrong, in which case the Fed might have to backtrack. Stanley Fischer asked, is the Fed too predictable? And the answer might be yeah.
Evan, I gave my take on the situation in France a few minutes ago, not being in France, but here you are in America. How do you see American enterprise at this point?
Well, it doesn't seem like the U.S. is going into a recession, pretty far from it, but it does seem like growth is just really, really anemic, despite the fact that consumer sentiment's kind of at a 15-year or so high, and business sentiment's also very toppy. Any kind of look at real activity, it's not shrinking, but it's just disappointing. New housing starts are at their lowest level since November. Auto sales are kind of peeling off. Factory production's at its biggest contraction in several months. I mean, nothing is showing that the U.S. is kind of going into to reverse, but it does seem like growth is kind of tailing down. The Atlanta Fed's GDP Now model, which is trying to predict what's happening in the first quarter, now thinks that the first quarter growth is going to be at 0.5%, 50 basis points.
Well, as a man says, we'll know more in 4 or 5 years. In the meantime, I would like to encourage you, listeners to this podcast, to keep listening, and also to suggest to us people you might like to hear from on these broadcasts. Russell Napier, a very, very distinguished observer of the emerging markets, is going to come in and see us on Friday, I think, Evan. And we'll talk to him, and that'll be great. And we are booking guests as well for the next couple of weeks. So please, if you have an idea of someone you'd like to hear about or from, do write in to editor@grantspub.com. Subscribe to Grant's, book the conference. What else? I guess that'll do it for now. But Evan, thank you, and we look forward to doing this again soon.
Thank you and goodbye.